broadly, our view on the market continues to be positive, although we believe that in the very near term, over the next 1 or 2 quarters, markets may remain volatile. The markets have seen a very hefty correction from levels of 11,700 odd in September to currently close to 10,100, and we believe that these correction in the markets has largely been due to macro headwinds like a rising current account deficit, a weakening rupee, and a rising crude oil price scenario. We believe that in the coming months we are going to see a lot of political activity, especially on the state elections front, and therefore investors are in cautious mode. Our belief is that this correction in the market offers a great opportunity for long-term investors to actually nimble into good quality businesses available at very good valuations. In fact, this could be a good time to construct a portfolio, and taking this perspective in mind, we have designed our Diwali portfolio for our clients. The first stock which we have recommended is Mahindra & Mahindra. Mahindra & Mahindra is a frontline automobile company operating in the tractor and utility space. In the UV business, we believe that the product Marazo, which the company has launched recently, is going to be a key growth driver for the company. In fact, the company expects to sell about 7,000 to 8,000 units per month, and we believe that it should be a very strong competitor to both the Innova Krista as well as Ertiga. We believe that the earnings recovery from this product would be partly felt in FY19 and fully in FY20. The tractor business also continues to grow in double digits. As far as other businesses of the group are concerned, like the automotive component, the logistic, and the IT business, we believe that these businesses would also add a lot of earnings growth stability to the company going forward. And our expectation is that the company could possibly show an earnings per share of close to about 47 to 48 rupees by FY20. So valuations look pretty good. We would suggest that investors should use this weakness in the stock to buy the stock. We have a target of around 1050 here over the next 12 months. The second stock we have recommended is Reliance Industries. Reliance Industries is an oil and gas major and has a very strong market presence now in the telecom space, especially Reliance Jio. Our sense is that both the businesses are set to grow quite strongly. In fact, the Jio business has already started to show profitability on the operating side, and despite the fact that ARPUs in the second quarter was slightly low, the gross addition to the subscriber base has been quite significant. In the broadband space, the company has recently decided to take a controlling stake in Hathway as well as Den Network, and we believe this would not only add customers but would also help the broadband network deepen further. Our sense is that Reliance definitely looks quite attractive from a long-term point of view. Our earnings expectation is around 84 to 85 rupees by FY20, and this stock also should be picked up on every decline, and even at the current odd levels. Our target price is roughly around 1300 rupees here. The third stock we like is ICICI Bank. ICICI Bank is a corporate lending bank, and we have seen a smart recovery in quarter 2 numbers, with the bank reporting a profit of almost 910 crores. Asset quality slippages have reduced considerably on a sequential as well as on a YY basis. Although the bank expects full recovery to happen in FY20, we believe that the asset quality stress is now definitely a thing of the past, and we could see better numbers panning in the third and the fourth quarter. The stock trades at a very attractive valuation of almost 1.6 to 1.7 times FY19 and around 1.5 times FY20 numbers, and we believe these are attractive opportunities considering that now a new management team is in place, and corporate lending definitely should pick up in the coming quarters. We believe the stock should be accumulated at the current level. Here we have suggested a buy on the stock with a target price of 395. The third stock, the fourth stock we like is a company within the IMFL space. The company's name is Radico Khaitan Ltd. Radico Khaitan is the third largest IMFL player and has several leading brands like 8PM as well as vodka and gin to add to its product portfolio. The company posted a very strong quarter 2 number with top line increasing by almost 15%, EBITDA growing by almost 18%, and the bottom line growing by 79%. A noteworthy fact about the quarterly performance was that in the first quarter the company repaid loans close to 130 crores. In the second quarter the company repaid almost loans of 60 crores. The management is very assertive that possibly it will become a debt-free business by FY21. And looking at the kind of consumption trends in the market plus a strong portfolio, our sense is that earnings recovery will be extremely strong not only in FY19 and 20. We have a buy on the stock price here, and we believe that the stock can give a decent risk reward. The target price we are looking at is around 510 over the next say 12 to 15 months. The fifth stock we like is a mid cap stock operating in the optic fiber space. We believe that this company called Aksh OptiFibre is definitely a deep valued stock, and our sense is that considering the kind of industry it operates, that is optic fibers, there is a huge demand supply gap which has benefited the company. In fact, this is a company which is located in North India and has a capacity of almost 7 FKM of optic fiber and almost 10 FKM of optic fiber cables. In fact, we believe that in terms of financials, the company has several earnings triggers in place. Last year, the company reported a top line close to about 600 crores and a bottom line of 20 crores. And in the first half of FY19, the momentum has been extremely strong. The company has posted a top line of 318 crores and a bottom line of almost 30 crores compared to just 7 crores. So our expectation is that for full year, we could see a bottom line of almost 65 crores. And going forward in FY20, we could see a bottom line of close to about 95 to 100 crores. Valuations appear to be extremely attractive, and therefore our suggestion is that this stock could definitely give good rewards to investors who want to take a medium to long term view considering the industry headwinds and the financials of the company. We have a buy on the stock with a target price of 60 here. The last stock we have recommended is CARE Ratings. Now CARE Ratings is India's second largest credit rating agency. It's a company which has got almost 20,000 corporate clients and operates across all the verticals in the financial space, especially medium-sized corporates, MSME corporates, as well as the SME sector. The company's financials are extremely solid. In fact, the company is a debt-free company, has roughly about 300 to 350 crores of cash, and has been generating ROEs in excess of 28 to 30% over the last 4 to 5 years. Dividends have also been quite liberal. Our sense is that with the with the kind of concerns in the banking sector and with the tightening of IBC norms, we believe that rating agencies are now going to play a very critical role, and therefore a lot of incremental business both from the corporate and the bond markets could flow in to rating agencies like CARE. Our belief is that the price currently does not discount the full prospects over the next 12 to 15 months, and therefore investors should use this opportunity to accumulate the stock. We have recommended a buy on the stock with a target price of 1275 here. So these are the 6 stocks we have recommended to our clients for Diwali. In conclusion, I would also like to wish everybody a happy and a prosperous Diwali.